we're going to be discussing retirement plans when you have a sole practice. My name is Tony Cameron with TLDR Accounting, and we provide tax and accounting services to therapists in private practice. So retirement. This is a subject that I nag everyone about. I usually bring it up in my first phone call, no matter what type of business owner you are, or if you're not a business owner, it is just one of those things that I'm like, no. We need to talk about this. If you're not saving, are you saving? And what is the best way to save? So when you are a solo practice owner in private practice, so you're the only one, you don't have any employees, it is just you're providing therapy services to clients, you're the only one involved in the practice, there's certain retirement options that we recommend. When you grow to the point where you have employees, we have some different recommendations, which is why we're just focusing on when you're the only one, you have no employees, it is just you. To start it off, a common question we get is, what about a Roth IRA? So a Roth IRA is a personal retirement plan. It is for you. It is not done through your business, but it does depend on how much income you made if you can contribute to a Roth IRA. So as of 2020, if you're single, if you made $139,000, you can't contribute to it, right? So if you're over that amount, you can't do it. If you're married filing jointly, it's $206,000. If you made over that, it doesn't work. If you made a little bit less than that, there's this phase out that goes back and forth, depending, right? Otherwise, you can ignore it. Most folks that are just starting their private practice, if they're not married, they're under that amount, especially if it's a part-year practice. So from a tax side of things, a Roth IRA means that you don't get a deduction for it, but you don't get taxed on it later, right? So it doesn't really affect your taxes, but it's a way that you can contribute to retirement. So like I said, it's a very good option if your income's low enough and you made enough money to then contribute to the Roth IRA. So it is one of the things that you can totally go for. The next option, which is one that I highly, highly recommend, is a SEP-IRA. So it's basically a self-employed pension plan. It's a retirement account. You do it because you're a small business owner, so you have to be making self-employed income to be able to contribute to a SEP-IRA. Now, a SEP-IRA is tax deferred, so that means you get a deduction the year you contribute, and then it builds up over time, and then future you has some money set aside for it. You will pay taxes on it when you take it out, but you do get that deduction in the current year. And when you're self-employed, getting a deduction to reduce the amount of taxes you paid is a pretty good thing, right? In addition, you can contribute a lot more than either a Roth IRA or a traditional IRA. So a SEP-IRA, you can contribute up to 25% of your net income from your practice, right? That's fantastic. There is a cap. So there's the 25% amount, or if say you made a whole bunch of money, the maximum you can contribute is $57,000. Right. That's just so much money. Our general recommendation is that you should be contributing 10% to retirement each year. So if you had a Roth IRA and you contributed 5 there, the goal would then be to whatever the remainder you need to contribute. A SEP-IRA would be a fantastic vehicle to do it, because a Roth IRA, you can only contribute $5,000 to $7,000 depending on the year we're talking about. But the SEP-IRA, it gives you the flexibility to contribute way more than that, and it gives you lots of room. It's also simple, right? So it's reported on your tax return. There's no additional filing requirements, right? Like, oh, I contributed $10,000, I contributed $6,000, I contributed $5,000, right? And it's just reported on your return. The retirement doesn't have additional reporting requirements that you need to do. In addition, you don't get locked into making that contribution each year. So say 2020, your private practice did fantastic and you have some money to put into retirement. Great, let's put that money into retirement. But say now in 2021, you're taking some time off, you had some burnout, and so you don't have any money, you don't need to contribute then, right? So when you make money, you can contribute more than when you don't, right? It gives you some flexibility there, which is pretty much awesome. Now, the reason we don't recommend it if you have an employee is because a lot of times you need to then contribute the same percentage to those employees. So say as the business owner, you contributed 10% of your income. That means for your employees, you need to contribute 10% of their income, right? There are some additional qualifications for it, and we'll go into that, the blog post, which will be posted below. The next one we get asked a lot of questions on, which we tend not to recommend as much, is a solo 401k. A solo 401k is fantastic. You cannot have it if you have any employees unless it's just a spouse. So you're good there if it's a spouse and you. It's a lot like a regular 401k. You make contributions as an employer and an employee. So technically you can put a little bit more money into it. There is more paperwork with setting it up. And you need to make sure that you keep track of the employer and the employee contributions and how much you're contributing to each. It's a little bit more complicated. As soon as you start adding more complications, a lot of folks are like, no, I'm opting out of this. It's one of the reasons why we do more lean towards the SEP-IRA, because it is a much easier, it's just 25% is the maximum you can contribute, versus the solo 401k as an employee, you can contribute up to $19,500 as the employee for 2020. And then there's the business contribution side of things, which again is about that 25% that you can contribute. Now you don't have to do the maximum for any of these, but you can't go over it, right? And so that's the biggest thing, is making sure that you don't contribute over. Overall, our general advice with the retirement is to making sure that you're setting aside 10% of your income for retirement. So future you will be thanking current you, right? You want to help out future you. We generally recommend a SEP-IRA since it's deductible. It's an easy plan to put together. And a lot of times you can sign up for them super quick, versus solo 401k. There is some lead time needed, so you can't do it on December, but a SEP-IRA, you can totally set it up in December. So that is just where our recommendations lie. Obviously, you can do what you want. Just follow the guidelines for each type of retirement account and the different regulations they have. If you found this helpful, subscribe below, or if you want any more of the nitty-gritty details, look at the blog post.